Good morning, everybody. My name is Katya Gorbatyuk, and I'm head of funds on the primary market side. You've heard the bigger vision for the London Stock Exchange to act as a force for good and mobilize capital at scale into a more sustainable economy. And that big vision and that big ambition permeates every business within London Stock Exchange. The funds business is no different. So what keeps us awake at night is not just about creating a liquid and robust market for listed funds and being a leading venue for listed funds, but also it's about availing access to innovative and purpose-led investment opportunities to a broad range of investors and mobilizing capital into the vital areas of the global economy. Climate mitigation and low carbon transition is one of these vital areas. Despite the current macroeconomic and political challenges, this remains to be our key priority, and I dare say particularly during these times. And green economy mark and voluntary carbon markets are the pillars towards executing on this vision. On our markets, we have 33 investment funds that have been awarded the green economy mark, totaling £18 billion in market cap. And in 2021, 7 of the 15 funds that IPO'd on our markets were the green economy mark funds. The opportunities to invest in low carbon transition are increasingly diverse, and I'm honored to have this panel who are experts at capturing these diverse opportunities. With us today, we have Anthony Catachanas, CEO of Victory Hill. We have Minesh Shah, Investment Director at Infrared Capital Partners, and Fotis Mikalakis, Portfolio Manager at Impax Asset Managers. So let me start off by asking each one of you about your investment mandate.
Perhaps I can kick off. Thank you, Katya, for having us, and thank you to the LSE as well for its initiative. This is an important one, and this country has a lot to say. Thank you for the mic as well. This country has a lot to say for its ambitions with respect to the green economy and promoting it overseas. We're in the business of exporting capital globally and addressing climate change, the energy transition, and accelerating it. We want to accelerate the energy transition on a global plane. And we do think that the UK in particular is particularly well positioned to help export and to help bring knowledge to that avail and help really move the needle and help accelerate the energy transition. I think you've heard from previous speakers just today alone, we're behind our targets. We have to obviously think about ways to accelerate this process, and we're in the mission of doing so.
Thank you so much. Minesh?
Yeah, thank you, and thank you to the LSE for hosting, and some really interesting keynote speakers that we had to kick us off. So I work for Infrared Capital Partners. We've been an infrastructure investor since the 90s, originally in core social economic infrastructure, and then in the 2000s moving early into renewables and flexible capacity. We have 2 funds listed on the stock exchange, HICL Infrastructure PLC and the Renewables Infrastructure Group, and I sit in the fund management of TRIG, or the Renewables Infrastructure Group. The proposition, what we do is simple. It's decarbonization, transition to net zero, but to do that, accumulating a portfolio that's diversified across Europe and looking to provide not only contribute to sustainability, but also provide investors with sustainable returns.
Thank you, Minesh. Fotis?
Yeah, thank you very much for having us here. So I work at Impax Asset Management. We have been around for a bit more than 20 years. Today we have 38 billion in assets under management, that's pounds, and all of that is invested in the transition to a more sustainable economy. I'm a co-portfolio manager of Impax Environmental Markets, which is an investment trust under our specialist strategy. And this is a strategy that invests in small and mid-cap companies that have pure play exposure to environmental markets. And that is a wide range of opportunities broadly classified in 6 sectors. The first one is renewables and energy efficiency. Second is about water, so infrastructure, treatment, and utilities. The third one has to do with the clean and efficient transportation, so from electric vehicles all the way to public transportation infrastructure. Then number 4, sustainable food and agriculture, for example, solutions that help reduce food waste. Then the circular economy, so things like biomaterials and waste recycling. And finally, the digital economy, digital infrastructure, so technologies and software that enable applications like digital factories and preventative maintenance. So we invest in listed global companies with at least 50% exposure in terms of revenues or profits from the themes I just talked about.
I would like to go back to each one of you for a summary of how do you differentiate yourself from other funds? Anthony.
Okay, let's kick off again. So we're very obviously a globally oriented fund. We've seen, when we came to the sector, we were interested in looking at where flows of capital were going, where most of our peers were investing. A lot of them had very core skill in investing in Europe, investing in the United States, in very developed markets predominantly. Our focus is, of course, in developed markets. The transition is happening everywhere. Developed markets are not spared. We know this very well, all of us in this room. But emerging markets are a big component of growth as well. As a matter of fact, if you believe the International Energy Agency, population growth is predominantly going to be coming in the next 30 years or so from emerging markets or emerging economies. And the growth in demand for energy worldwide is going to be coming from another part of the world. And we need to be conscious of this. If we want to subsist and exist in a world that is growing and evolving, we need to adapt and be realistic with respect to tackling the transition and look at it from a global plane. Another differentiator that we have that makes us a little unique on the LSE within our cohort is that we're technology agnostic. One of the realities of investing in the energy transition on a global plane is that you have to reckon with the reality that every energy system around the world is different, have different histories, different paths of evolution. The energy mix in every country is very different. And what that means and implies is that we can't just be investing in renewables alone. We need to help facilitate a transition in different degrees, in different ways, in different markets around the world. So we're sustainability oriented, high impact value oriented when we make investments. We look to create and enhance change, but we recognize as well the local realities of the different markets that we invest in around the world.
Thank you, Tony. Minesh, what makes you different?
Yes, I think firstly that we have a diversified portfolio across Europe. So, all the way from kind of the Nordics and the Northeast to Iberian Peninsula and the Southwest, some 3,000 kilometers apart. And we invest in a variety of technologies as well. So we have offshore wind, onshore wind, solar, and flexible capacity. And I think what that allows us to do is provide a smoother journey. So in low wind years, you may have sunny years. In low wind and low sun years, actually your flexible capacity can do better. And what that means is you can manage a portfolio as a whole and soften the kind of impacts of any one of those areas or indeed any one country. I think the second is scale. TRIG's market cap is nearly £3.5 billion now. And what that means is it really broadens the sectors and the opportunities you can look at. We now have 6 offshore wind projects in our portfolio. These are incredibly huge projects, absolutely crucial, as the Minister was saying, to the transition to a green economy and a zero carbon future. And the scale means that we can invest and promote these. The third, I'd say, is our market correlation. So the low beta that the funds in our space share, often lower than 0.4 and at times 0.2 to 0.3. That low correlation to the market, if you look at the history and track record since our IPO in 2013, I think is a key attraction to investors and really sharply brought into focus at this time. And I think, I'd be remiss to not say that a key differentiator is the managers. A lot of the managers in the sector have incredible track records. For us at TRIG, we have a unique proposition of having InfraRed as an investment manager with a track record going back to the 1990s, but sitting with us at the top table, we also have an operations manager, RES, one of the world's largest developers of renewables, real specialists. Their history goes back 40 years, really at the infancy of the renewable sector, and together we can deliver a leading proposition.
Thanks, Minesh. Otis.
Yeah, so I would start with saying focus is one point. So this is all we do. This is all that Impax has been doing from day one and all it does today. Then the second point is that we have one of the largest teams in the listed space that is exclusively looking at this opportunity set. We have a team of about 30 investment professionals, so large dedicated resource. I would also point out the longevity. So we have been doing this for more than 20 years. So we have seen during that time, following these markets through the cycle, have been keeping up with some of the boom and bust phases that have come up in environmental markets. And in that time, we have built a strong performance track record, outperforming global markets over 3, 5, and 10 years. Then I would also talk about, we have a lot of experience in classifying environmental markets, understanding where is the boundary, what's in and what's not in. And we actually have a long-standing partnership with FTSE, where until a few years ago, we were providing our investment universe as a basis for their environmental indices. And then, we have been integrating ESG for a very long time as just part of our fundamental company research. And also we were one of the first managers in the listed space that quantified and communicated the environmental impact of our investments with a process that was externally audited from day one. So these are some of the key differentiators I would point out.
Thank you, Fotis. Tony, you mentioned emerging markets as one of the focal points of your investment strategy. What are the challenges that you face in emerging markets?
I mean, the first thing you have to bear in mind is you need an experienced team. We're a cohort of cross-border transactors. We've been involved in energy on a global plane, both in conventional energy as well as renewable energy, for on average at the senior cohort around 25 years. Our longest standing members are chief investment officers. One of our co-chief investment officers has north of 30 years in energy. We've seen the evolution of different markets. The ethanol market is at its nascent stage, evolve in countries like Brazil, developing obviously a variety of other fuel-related markets in Mexico, in Indonesia. We've seen coal markets in the past also evolve in Europe and so on. But we've also been heavily involved in investing in technologies that are still very important and that often get missed in renewable portfolios like geothermal technology. Geothermal technology is a very unique technology that requires that one has an appreciation for resources that are below the ground and understands the risks that go with extracting something that is below the ground. We certainly are attuned and very confident with respect to our knowledge of these types of technologies. You won't often find them in renewable portfolios. But it's to say, when you go to emerging markets, you have to have experience going there. We have a team that is extremely diverse. We're very proud of the diversity of our business. We have more nationalities than we have people, believe it or not. Certainly more languages and passports than we have people in the firm, and that's probably going to continue to subsist going forward. It's an inevitable consequence of doing global business. You need people with language skills who have experience investing overseas and being overseas. I myself come from a very diverse cultural background and family background. That helps a great deal, but it's always has to be complemented with knowledge and skill, to be able to understand local realities. So that sensitivity to understanding local energy markets around the world is extremely important, and understanding also the evolution of those markets over time is extremely important to be able to invest in it. People are always very surprised when we put money in countries like Brazil. Brazil, and I hope we could talk about it in a bit more detail, on this panel. Brazil is bar none probably the most advanced energy market in the 21st century. Has a heavy reliance on hydro and has preconditions that we here in the UK and in many developed markets where we had a historical reliance on technologies like coal do not have to deal with the transition away from coal and the dependence we have on hydrocarbons like coal. So we need to remember that other countries around the world can also set an example for the rest of us. And that's the business that we're in. We relativize these things. So having that local understanding, cultural understanding, having the experience of having gone through cycles and doing this for quite some time allows us to be able to deploy efficiently. And having that local reality also allows us to appreciate the advantages that some other economies in other countries have, and we should be learning from others in this context.
Thank you, Tony, for these insights. Fotis, if I may turn to you, what are the differences you see between investing through private funds versus listed fund structures?
Okay, so I would say the key difference between investing in listed companies or private companies would be this concept of additionality. So, when you deploy capital in a private business, it's very clear that that capital finances the growth in that business. It's a lot more indirect when you buy shares in a listed company. In terms of our experience from investing in private companies, I would say it has been pretty challenging, it's fair to say. So that's something we used to do in the early mid-2000 period. And at the time, a lot of the private companies in environmental markets were very, immature, unprofitable, not very easy to scale. So it ended up being a detractor in performance of the trust. And if we take a step back and think why that is the case, I think it's because at the time, a lot of these private companies were very capital intensive. For example, a lot of fuel cell companies back at the time. So, needed a lot of capital upfront, frequent financing, so it did not work. I think it's fair to say that today the landscape is different. So we have seen a lot more software opportunities coming into environmental markets, so a lot more asset-light business models. But we have decided since 2009, 2010 to stick to listed companies that are proven, profitable, where the economics work. And our thesis is that these companies will grow earnings at a faster rate than the market, and that will drive investment performance for us. I think also it's fair to say that in terms of a bit of a market landscape, I think there were quite a few trusts back, if we go 15, 20 years, that were investing in environmental markets through private companies. But I think, as you're hearing from the panel today private investments in the space are a lot more going towards infrastructure than private companies. So yeah, that would be our experience from that.
Thank you for this.
Can I just add to that point?
Absolutely.
I apologize,
Yeah.
Ganesh, and you'll probably have something to say about this as well, actually. So we benefit here in the UK of a medium being the investment trust market that is a 150-year-old market. And it resolves a mechanism that many markets around the world are trying to find a solution to. And that is to do what we do as agents and financial investors of really channeling capital into parts of the economy that need capital. And that is our job, fundamentally, is to channel capital into parts of the economy that requires capital. The investment trust market here is age-old, but happens to resolve a lot of issues that the private markets that have been accumulating capital so aggressively over the last couple of decades actually resolves very well. We're able to speak to a cohort of money that can attract retail investors into the market and bring the retail part of the economy into the discussion. That's an important process. It's an important process for us, especially with respect to what we do in our focus with respect to the energy transition. And many of you here that have a focus on the broader green economy in its various shades and forms. We need to be able to speak to capital on a very broad basis. And this format, this medium, this tool is second to none with respect to being able to do that. It's almost akin to a structure where we have the reliance and the benefit of being able to work with market makers to help facilitate liquidity for those pockets of capital that require it, while at the same time being able to access illiquid or intrinsically illiquid asset classes. That's very rare. It's literally a holy grail in the financial industry. And it's not surprising that this holy grail has been found out by private markets participants private equity firms, infrastructure firms who have been amassing private capital for many decades now, are now looking at the investment trust industry en masse, trying to appeal more to retail markets. This is the next bastion for private capital markets, and it is certainly going to bring more capital here to the UK and hopefully to the LSE. So that has to be mentioned, I think. It's a very important point.
Thank you, Tony, for this comment. And it's very much part of our priorities, both for the London Stock Exchange and the funds business within it in particular. So my question, thank you for that. So my question to Minesh is related to it, actually. How has your share register changed since inception? And do you see more retail being part of it?
Yeah, thank you. So it's an interesting question. So Trig listed 2013, so nearly 9 years ago now. And it's fair to say that the composition of the share register has not changed significantly over those 9 years. Now, there's two observations that come out of that. One is the loyalty of the shareholders that we started with and have since joined the register, and the fact that they have continued to back the strategy through successive fundraisers to take Trig from what was at launch 300 million to what is now 3.5 billion market cap. So I think that says something about the sector. And what are those investors after? They're after exposure to assets that they could not get exposure to easily. So these real assets, they're also after access to expert asset managers. I think what's interesting is in this space where the investments are real assets, the asset managers are active asset managers. The team at Infrared, at RES, and each of the managers that the investment company is able to access is huge. At Infrared, we have 170 plus people. At RES, they have 3,000 plus people. And through the vehicle and the structure that it is, you have access to those wider teams of experts and being able to call upon the skill sets when you need it. And then finally, the nature of the investors, they're after long-term investments. The fact that they've been in the vehicle for so long, they're looking for the long-term steady income to match their liabilities, to match their strategies. And they have seen that, and they've seen that resilience through cycles as well. If we look at the flip side, so we talked about who's been in the register. I think you touched on retail, and we've not seen the huge increase in retail that I think many of us over the last few years have perhaps expected to come in. Fundamentally, the themes of these vehicles is aligned to themes that should appeal to retail. It's access to illiquid investments, it's strong managers, it's steady income to match their own personal liabilities, it's inflation correlation, which we can perhaps touch on later as well. I think the challenge is one of awareness. And I think there's a huge role for the LSE here. They are doing a lot, and I think there is more to do to educate retail investors that, firstly, this universe exists, and that there are a lot of propositions in this sector, so they have choice. Secondly, that how the structure works as well, because I think if you're not used to looking at this space, then you look at it and you go, okay, so it's an investment company, not an operating company. It has an external manager. I've got these fees to pay. Why is that structure there in the first place? And I've talked about the teams you can draw on. And why am I paying fees? It's the active asset management that you get, the hands-on approach to asset management that you get. And I think if the LSE, other organizations, and we as an industry are able to promote that more, then the profile amongst retail investors will increase, and I think we will see funds flow into the sector. My fundamental belief is we can and we do work together as an industry because there is enough potential capital allocation out there to go into all the vehicles in the space.
Thank you, Minesh. And so may I stay with you now on some of the macroeconomic and political factors that are affecting everybody and every business, may I say. So what do you see are the main impacts of, firstly, the COVID pandemic and now followed by the crisis in the heart of Europe? How does it affect what you do?
Yeah, so happy to continue. So look, I think I spoke earlier about the low beta and the low correlation to the wider markets. You're seeing, if you look back at the charts, you can see that when the pandemic hit in March, April 2020, if you just look at the stock market, the general stock market, how it came down and how long it took to recover versus the renewables and infrastructure funds, the wider market was weeks, months. Within the infrastructure, it was perhaps within even a week that there was the general market sell-off, but then the recovery that followed. And I think that was a recognition of the low correlation to the wider economy. Look, more recently, we have seen the crisis in Europe that has only exacerbated what was already challenging power markets even coming into 2022 and challenging supply chains coming into 2022. The benefit of the infrastructure space is, particularly in renewables, there is that correlation to the power markets, and we can talk about how that feeds into inflation. But clearly, that alignment is there. And the key about active asset managers is we can look at challenging supply chains, and we can think about how to manage them. When we think about portfolio composition, we think how much exposure to take to construction, to securing future contracts, but also then how to manage existing contracts. So we may often we're building new projects at the moment. We're building about half a gigawatt of new renewables capacity. Many of those contracts we locked in the last year before, which means actually in the current inflationary environment, we've gone in with an investment case that is perhaps protected on the cost side. And then if we think about inflation more broadly, and the others on the panel will have comments on this particular point as well, infrastructure and renewables, many of the underlying revenues, and fundamentally a lot of what we invest in is about how you manage the revenue line. Many of those revenues are linked to inflation. So if we take the contracts for difference that the minister mentioned earlier, those have a linkage to CPI. Some of the older subsidy regimes have linkage to RPI, and where you have exposure to the market as a whole, then clearly power prices are a key driver of inflation. And so what we're seeing is that inflation environment flowing through into revenues, and a reason why even more recently when you've seen kind of a more general market sell-off, renewables have continued to hold up well.
Thank you, Minesh. Tony, may I turn to you with the same one?
Sure. I mean, we forget that energy prices obviously are a strong driver of inflation. They're a strong contributor to trade balances. They're a strong contributor to economic growth in an economy. Very difficult to disassociate energy prices from many of these things from an economic standpoint. There is a correlation, unfortunately, a very strong one, and reliance, particularly in this part of the world, on natural gas. This is no news to anyone, I think. Anyone who's been watching the news lately, I think will understand that we have a dependency in Europe, continental Europe more so than here in the UK, on gas flowing from the east to the west. And very unfortunately, that coupling or that association, that correlation is very, very high and affects power prices in particular. What we're realizing these days is that we're increasingly moving away from talking about energy in oil and gas terms and having that export and import driven or trade driven context of energy, where demand and supply balances, production of oil and gas in particular is affecting energy prices worldwide. We're seeing a decoupling away from that and a migration towards electrification. Electrification is certainly the goal, the ambition. If we have more renewable power generation in the system, we imply greater electrification that doesn't rely necessarily on hydrocarbons. And therefore, as that migration, as that transition happens, we're going to be talking about energy, on CNBC, on Bloomberg, not to name a few. Not that those institutions don't have a thing or two to say about energy prices, but we have to stop talking about that in hydrocarbon terms and start talking about it more in electrified terms. And that's going to change the rhetoric as well. Over time, we'll see a decoupling inevitably. And I think many consultants, certainly in the market, some professionals will, who forecast energy prices in the long run, certainly see a decoupling, on a localized basis in many markets, particularly here in the UK, away from sensitivity to natural gas prices in particular. And so that decoupling will happen further down the line as we build more renewable power generation, be it offshore, i.e. in scale and size, or we go down, a debatable question around nuclear, or we go down other forms of energy. Maybe hydrogen is the answer, and then we'll go back into a trade discussion with respect to hydrogen because it is a commodity that is prone to exportation in particular. But we need to be conscious of, understanding these fundamentals and the direction of travel, because if we don't take that into consideration, we're going to be locked in a steady state of thinking about the world in hydrocarbon terms and not ever migrating the conversation away from hydrocarbons altogether. That needs to happen, and we need to drive that conversation, all of us together. We're in the business of making sure that that conversation doesn't just happen here in the UK, but we're also doing it, for example, in Australia, where they have another issue with respect to relying to the tune of 70% of the energy mix on coal. Australians at the moment are experiencing power outs. There is shortages and rationing for power, on the eastern seaboard of Australia. This is unheard of. This is a developed economy. Can you imagine having to turn off power in your homes when it's time to put the kettle on here in the UK? I mean, that would be disastrous. Let alone not being able to watch EastEnders. So this is just, the reality that we're having to reckon with now in this transition where the system is changing fundamentally, and we're having to rethink all of the concepts that we had initially put together and had thought about its effect on the economy, its effect on our pockets in inflation terms, its effect as well on trade, and more importantly, its effect on where we drive capital investment as well.
Okay. Thank you, Tony. Fotis, how do macro factors affect your funds?
Yeah, I mean, it has definitely been nothing but challenging the past 6 to 9 months. We have seen unprecedented disruption in supply chains that's lasting a lot longer than anyone was expecting. That is creating inflationary pressures. Central banks are trying to control that with interest rate rises, but it looks like it's increasingly outside of their control. So we have more and more commentary in recent weeks from the Fed about the risk of a hard landing. So recession really went from a tail end sort of risk to a very likely outcome in the next 12 to 18 months. So, in that environment, it has been pretty challenging for us. And to give you some context, what that means is that we have seen a very violent rotation away from growth and quality companies and towards value. So MSCI ACWI growth is down 20% in the first half of the year, ACWI quality down 17%, and ACWI value down 4%. So really a massive outperformance of value, which for us is pretty challenging because we do have a quality growth bias. That's a function of the types of companies we invest in. So it has been tricky. An interesting dynamic to highlight is that whilst in this period the multiple of the portfolio has really come down, so valuation really came down, the operating performance of the underlying companies has been pretty strong. So in the most recent earnings season, we have had 70%, 70, of companies in the portfolio delivering better than expected results, both at the sales and the earnings level, which for us is a sign that our companies do have the pricing power, they can offset inflation and really navigate through this difficult environment. And on top of all of that volatile mix, we've had obviously the horrible situation in Ukraine with the invasion there. So that is contributing to the energy crisis that we've already talked about in this panel. And for us, that means that we are seeing a lot of tailwinds from that for our renewable energy and energy efficiency companies, because suddenly everyone is talking about the importance of having security of energy supply. So net-net, where all of that leaves us is, I would say, with a portfolio that is a lot more grounded in valuation terms, a lot more in line with the very long-term average multiples, and with a set of companies that have so far demonstrated solid earnings delivery. So pretty excited about the current portfolio.
Thank you for this. Tony, I would like to perhaps go back to COP26 and the resolve that was broadcasted there. What has changed on the regulatory side since then? What have you seen?
Yeah, I think we did a particularly good job, I think, at COP26, certainly for the GFANS initiative. I think that Mark Carney was, promoting at ICOP. We've done a few things right within the context of COP26. It was, I think, generally speaking, I mean, there are different views, I suppose. Pundits have been, perhaps in my mind, too quick at pointing towards COP26 and saying that it was less of a success than previous conferences. I actually think that we've amassed more pledges at COP26 than we had in previous conferences. And we've been far more effective, certainly within ICOP, which is the financial part of the conference where financiers gather together and get around a table and discuss issues. And that was particularly effective this year. Far more effective than in previous years. Driving capital into the right place is a mechanism that we're all involved in this business, and everyone here in the room, and certainly the LSE, is involved in. From a regulatory standpoint, I think there are initiatives around the world in recognizing specifically that we need to accelerate things, and that acceleration I think is now a reality everyone has to reckon with. And I think initiatives around having to deal at the same time with the headwinds that we've been facing from issues such as the war in Ukraine for most of Europe. I think, again, the UK is less affected by importing natural gas from Russia than perhaps others in the region. But having to deal with the balance of trying to implement favorable regulation to help drive more capital of a private nature, not government balance sheets in particular, and driving that more in the right direction to help facilitate the transition, has been perhaps muted because of these macro headwinds. And it's a shame. It's a shame that these initiatives haven't been picked up and put more in the spotlight, because there are many. We just heard, obviously, a member of cabinet mention that there are initiatives around promoting technologies like hydrogen. This is important to do. There are initiatives around putting the fiscal balance sheet to work, in a variety of sectors, such as net zero natural gas-fired power plants, to create more balance on the grid. And so these sorts of initiatives are initiatives that unfortunately don't get enough spotlight and are curtailed by headlines around other issues around the world, such as Ukraine. Very unfortunately, the barbarism that is happening really in the Ukrainian context. So there's unfortunately not been enough said about what is happening and what governments are actually doing to enable it. We forget, by the way, if we're true to the United Nations Sustainable Development Goals, we forget there are 17 of these goals, which are global ambitions for every country around the world, 175 signatories to that particular framework. The 17th goal out of the 17 is partnership for the goals. And what that means is we have to make sure that state and private actors act in concert to be able to deliver on a said goal. We have to work together. And we have to work together as well as a community, certainly on the private side, to harness capital and drive it in the right way. And that's what the GFANS initiative was particularly successful at doing. So from a regulatory standpoint, governments are trying to help, but I would argue actually that the private initiatives this time round took far more spotlight, and I think rightly so.
Thank you, Tony. Dinesh, how have the outcomes impacted your investment strategy?
I think one of the great things about COP26 is it's reminded everyone that a whole economy approach to decarbonization is critical. a lot of focus of debate, discussion, also government support has been on renewables, and certainly that has benefited our strategy, and it will be a core part going forward. But you've got the other side of the coin, which is the demand side, the need to electrify heating, industry where possible. And this will create the demand that will sustain the renewables business model long into the future as well. And I think that is an area where public policy is now really taking hold. Great to see the increase in government commitment from 5 to 10 gigawatts on the hydrogen side. All of this is going to create demand for the renewables that we are deploying at pace and going to support that business model. So the other thing that's taken hold and gained traction over the last couple of years is also the TCFD. I think people are coalescing around those recommendations. People are taking it more and more seriously. And if you really get into the nuts and bolts of that and do scenario analysis, that it can inform portfolio composition. So take, for example, in a renewables portfolio, and I touched on earlier the benefits of having a diversified portfolio. If you do net zero forecasting, then renewables and flexible capacity, so wind farms and solar, together with batteries in the same portfolio, actually help towards the net zero goal. And when you do a TCFD scenario analysis, it improves your business strategy and business proposition. So it is actually informing strategy and portfolio composition, which I think is great. And investors should be carefully reading those kind of disclosures. They're not just regulatory disclosures that are buried somewhere in an annual report or a sustainability report. They're actually meaningful disclosures that are worth reading.
Thank you. Fotis, what about outcomes of COP26 for you, for your investment strategy?
Yes, so maybe I would take a step back and start with COVID. So COVID-19 has been an event that forced governments to work together and launch a global scale response to what is a systemic risk, essentially. And then with that background, we went into COP, and I think there was consensus there that actually climate change is the next systemic risk that we need to deal with, that we cannot leave unmitigated. So what we saw there is definitely a step up around net zero. So a lot of governments and corporates talking a lot more about that. I think today we have something like 90% of global GDP covered by national net zero pledges. We see more and more companies committing themselves to net zero targets, trying to reduce their emissions and decarbonize their operations. So that's one big thing I would highlight. Then the second is there was a lot of talk about the just transition, so making sure that we do this net zero transition, but making sure that we have the support of local communities, that we don't have big parts of the world sort of losing out as we do the transition. And then a lot more focus on biodiversity and nature-related risks, which I think is something that has picked up in the past few years as a discussion point for the financial community. So we have all of that. Then more recently, Repower EU, I think that has demonstrated the resilience and the credibility of the European Union's Green Deal. And what all of that means for us, I think we have seen that the types of companies we invest in are, I would say, on the right side of all of these policy developments and initiatives. So if you think about things like renewables, rooftop solar, heat pumps, all of these are solution providers to the challenges that these policies are trying to address. So, definitely see that as a positive. And if I just make one last point here is that, we do see policy as a driver for performance, but we do not invest in companies that need blue sky scenario policies to work. So we invest in companies with proven economics and but are definitely benefiting from the incremental tightening of policy standards.
Thank you, Fotis. We encourage the audience to ask questions. In a couple of minutes, I'll turn to you for questions. And in the meantime, would like to ask each one of you, where do you see the opportunities for the future? Where are some of the unfunded areas of areas needing further finance?
Well, okay, I'll have a first stab at it. We've seen, I mentioned geothermal earlier, for example, and geothermal is an interesting technology. We've been seeing geothermal technology initially relied on high temperature resources, below the ground, meaning steam that's been trapped, below the ground for many years, for hundreds of years, even thousands of years, and can be released and spin a turbine and generate power. And usually you would find this technology somewhere along fault lines around the world. So you'd find them in Japan, you'd find them in my home state, California, you'd find them in Iceland, Turkey, Greece. So that's the sort of attraction. That made for a very narrow remit of opportunity set for investment. What we've seen now is that geothermal technology has been evolving increasingly to being able to generate power from very, very low temperature resources. And you're finding now that you can apply this technology in countries like Hungary, for example, that are nowhere near a fault line and have resources that are lower temperature, steam resources, below ground, and you're able to generate power pretty efficiently with this evolved technology. So being attuned to this evolution of these technologies that are proven, that exist, and that are very important resources for the future, that are renewable and sustainable, is very important. Hydrogen, for example, gets talked a lot about, in the press. It certainly has a lot of potential. It has a huge amount of potential, but funnily enough, is a resource that is not new to the energy industry. I mean, the oil and gas industry has been separating hydrogen molecules from hydrocarbons for a very long time, and they've been re-injecting hydrogen molecules into fuel molecules to create different grades of fuels. And so we've been playing around and toying with hydrogen for many decades, actually, already. The question is, are we using it in its purest form to now generate power? And unfortunately, we still have to prove, I think, the commercialization path, the utilization of hydrogen. That needs to evolve a little bit before it becomes, let's say, a more sustainable and viable investment proposition. That said, if you don't invest in it, well, you're not going to help it evolve. And so, one has to have the courage of recognizing the opportunity at the same time. So groups like ours, I think, have the ability to do that, to take that kind of risk, to understand the applications of technologies as they're evolving and going in the right direction. We do need certain preconditions. There are conditions. We need, a good insurance backdrop around the technology. We need EPC companies or constructors to be able to underwrite and fully wrap construction around it. But this again probably points to another feature of what we do, is that we actually spend a lot of time building new infrastructure and helping support these new technologies for the future. If you don't drive capital in that way, you're not really helping the cause, are you? So you need to be able to help facilitate capital into greenfield projects, and doing that on a very broad basis. So wind technology is evolving as well. We have in our private equity portfolios, we currently have a company that builds micro turbines, and it is absolutely mind-blowing when you look at these technologies and how they're applied in urban areas. Now, we've all seen solar rooftop panels, and you might see a container somewhere hidden in some urban space. But what you won't see more often than not is a wind turbine on the rooftop or on the side of a building. That's a little less common, and yet it took a team coming out of the Formula One industry to start building hyper-efficient turbines for urban landscapes. Where if you think about Canary Wharf a couple of years ago, I saw someone literally lift off the ground as the wind was funneling down North Colonnade. If you believe you can capture that kind of wind resource, blowing strong enough, and you have an efficient turbine well positioned in urban areas, you can certainly generate power. And so, there are a lot of concepts now, a lot of minds being applied to what are proven technologies, but are being reformulated into different contexts And I think we need to be more attuned to that to help facilitate the transition, because that's what it's going to take. A little courage, a little innovation, and then groups like ours, I suppose, and like many of us, to drive capital in the right place, and help de-risk this the proposition, I suppose, for investors.
Thank you, Tony. A little courage, a little innovation, and one of those scenes that you observed in Canary Wharf to spark a thought. Yeah. Minesh.
I think there's an important distinction here between funding and financing. Yeah. And the minister talked about the CFD round being 250 odd million. That's actually a relatively small number in the context of the scale of that CFD round, which is many, many gigawatts of capacity. And I think what that shows is a small amount of government support to the revenue line, a small amount of government funding, because renewables is now cost competitive with the wholesale market, can actually activate a huge amount of financing, right? That 250 million is going to activate billions and billions of financing to deploy these offshore wind farms. And that's absolutely necessary, needed to continue when we think that the UK's current installed capacity of offshore wind is of the order of 10 gigawatts, and the ambition is 40 gigawatts in the next, 7.5 years now. So renewables will continue to be an area that requires significant financing and a massive opportunity set. If we look at the other side, and you've already touched on some of the challenges, and we talked about this whole economy approach, there are many areas, particularly on the demand side of electricity, to drive electrification where greater funding is required, because whilst some of the technologies may be well established, electrolysis and what have you, their application to creating green hydrogen, say, is relatively nascent. The business model is not necessarily there. We know government are engaging with investors to try and design what the future hydrogen business model looks like. But this is somewhere where the pace of policy development needs to be quick if we're to continue towards our goals. And there is going to need to be government funding there to help these more nascent sectors mature.
Absolutely. Otis?
Yeah, I mean, over the years, we have definitely seen subsidies as a key part for making emerging technologies and new opportunities work. Renewables is a great example. We've seen a massive drop in the cost of renewables, but for that to happen, we needed to have some of the more generous subsidies in their earlier years. So today, similar to what the other panelists said, I would flag hydrogen as one of the technologies that definitely need more. So hydrogen has been a few boom and bust cycles. It's definitely not a new concept. And always the issue was that we did not have the support, the financing to scale the technology, scale the infrastructure, and make the economics work. I think what is different today is that we have renewables at a very, very lower price. So, this is a key input for green hydrogen. So that's one change. And then we also have governments increasingly including hydrogen as a key part for their net zero targets, as a key sort of ingredient to reach some of the harder to decarbonize sectors. So, this is a difference. And, but if you see at the targets for hydrogen and the actual installed capacity, there's a massive disconnect there. And that's because, we still see that the economics are not straightforward, they're not there yet. So even though there's a lot of capital that has been deployed to companies active in the hydrogen space, I would say that's definitely an area that needs more support. And governments have definitely a role to play there.
Thank you. I'm opening this for questions from the audience.
One question just about something perhaps wasn't touched on too much. There's a lot of sort of coverage at the moment, sort of political and commercial, about mini nuclear reactors, Rolls-Royce and all the rest of it. It's one of the biggest stories that's been bubbling away for a number of months now, and obviously there's a lot of vested interest. So I'd be interested in the panel's view on mini nuclear reactors and what role they may have to play.
Yeah. The question for our online audience is about nuclear reactors and the role of nuclear in the mix.
And the mini ones in particular.
Yeah.
Yeah, I think we again, like most technologies in energy and most technologies in general, we've seen an evolution of the sector over time. It's funny, we did a bit of research, for an interview I was giving for a publication not too long ago around our views on nuclear. I can't remember who it was with, Wall Street Journal or someone of the sort, and they had asked what our views are. I think one thing that has to be said is that past nuclear technologies, of which there are, I think, roughly in the United States alone over 90 plants or nuclear sites in the U.S. that generate power. What we don't know and what is less published in nuclear are accidents and issues with the technology and the catastrophic reality of when things go wrong. And we haven't been publishing that as much. Possibly correlated to the fact that many of these sites are large in scale, require public funding to a great degree, and more often than not, have a political agenda tied to them. And so it may not be convenient to disclose accidents of a nature, but if you dig deep enough, you realize that technologies of the past in nuclear have had a catastrophic track record. And so things more often than not go wrong. I think there's a cohort that have been investigating how to improve things, and thank God for that. Thank God we have people who are inquisitive enough to want to try and improve things. Bill Gates has been on the forefront of trying to develop new nuclear technology. He's been forwarding that with Breakthrough Energy Ventures and a few other initiatives. The Bill and Melinda Gates Foundation as well has been investing indirectly as well into these sorts of technologies. They have pots for it. But what we've seen is they've been going down the micro generation sites that you've mentioned. They go down different forms of as opposed to fusion, fission, or other technologies. And we need to understand that a little bit more. And then we also need to deal with the waste issue, which frankly still hasn't been resolved. And if you think about putting that in a sustainable context, I have a hard time admitting that something is sustainable when it produces waste. And when the waste can't be dealt with efficiently or in a circular way. We cannot deal with enriching matter as we do. We take uranium, we enrich it to be able to have a higher yield within the context of power production. And as we do that, there are consequences. We have to deal with high-yielding, enriched uranium, within that context in a waste, phase, and that's still an issue. I don't think that we can easily resolve penetration of renewable power generation and the reality that goes with renewable power generation in the mix, which implies intermittency. Intermittency is a problem for renewables. We have to deal with it. When the sun stops shining, there's no power. When the wind doesn't blow, there's no power. We've experienced it in this country. We've had it just last year. We've had power outs in the winter of 2021. That is a problem. And we need to counterbalance that with base load at scale. And one of the things that nuclear does do is base load at scale in an efficient way and in a way that doesn't use hydrocarbons, but is not necessarily sustainable. And that's an issue. So are we trying to get away from hydrocarbons, which is where the rhetoric is? Are we dealing with the safety issues that that sector in particular has been plagued with? I mean, I don't need to mention Chernobyl and Fukushima. I mean, this is recent history for some of us, I suppose. Chernobyl might be a bit more distant, but Fukushima is certainly recent history. I mean, we need to learn from those experiences and make sure that they don't repeat. Hinkley Point may be the brand new standard, may be something that we've never seen before. It may offer a good solution, and we heard earlier that 8 new sites across the country may offer a good solution. That is possible. Let's see. We need to see. But it has to be done in a way that learns from issues of the past. And we have to recognize that sustainability is not the same as moving away from hydrocarbons alone.
Thank you, Tony. That was comprehensive. Any other questions? Yes, Gillian.
Just touching a bit more on energy efficiency. Obviously, there's a lot of focus on new sources of energy and generation, which is key. But obviously, so much of the world's energy is actually wasted before we use it. I think it's 60-odd% before it gets to the consumer, and then the consumer wastes another 20 to 30%. So how feasible do you think it is for us to use less? And how do you factor that into what projects you're doing and how you forecast the revenues for the long term based on that?
I have a view, but I'll let you guys please.
Yeah, why don't I start on this one? So, look, I think this touches on the fact that I was speaking about a whole economy approach, that it's not just about generating more clean energy, it's also about the demand for it being there and also reducing the overall demand. And, I think it creates investment opportunities, the need for flexible capacity to respond to some of the outages that we spoke about, be it on a short scale with batteries, a bit longer with pumped hydroelectricity, or even longer perhaps with hydrogen sometime in the future. I think all these areas need to move forward. You spoke about energy efficiency. I think the challenge there is, from an investor's point of view, is doing it at scale. And I think that we have seen that you have to be able to then aggregate a large portfolio, and you have that B2C interface. You need an expert team to help you manage that. If you can achieve that, then I think that there is a role for investment there, but achieving it at scale is a challenge. Just to link it back to the point earlier, the question about hydrogen, so about nuclear, all these different technologies, all these different strategies need to be debated and discussed to overcome the sheer challenge that is in front of us in relation to decarbonization and energy security. So they should all be on the table. We then need to consider the investment merits of each one. And what is great these days is investment merits include sustainability, includes an assessment of the principal adverse impacts in relation to the supply chain, in relation to the waste consequences, in relation to also, when it comes to energy efficiency, how you interact with the consumer as well. These are all core to the investment strategy, so hopefully it means that the kind of things that you're speaking about can be delivered alongside greater generation as well.
Yeah, and if I just add something to that, so for us, definitely energy efficiency is one of the big opportunities out there. It's one of the biggest exposures in Impact's environmental markets in the portfolio, and we do think that this is not something that is being discussed as much as it should. I mean, we have seen recently with REPowerEU, for example, more emphasis being placed on that. I think there's a new target for contribution from energy efficiency to net zero. That's, I think, went up to something like 11%. Now we still need to see how that will be implemented, because it will be the individual countries putting together national plans. But whether that's insulation panels, LED lighting, solutions for the industrial environment, there's definitely a lot of companies out there doing solutions on that, around that. And the last point to make is that if we go 15 years ago, energy efficiency was about making hardware, run faster, be more efficient, be smaller. I think now there's more and more of a role for software solutions that come into the picture, where it's about having this sort of more integrated approach, combining different parts of a system and seeking to find efficiencies from there. But that's definitely, we think, a big opportunity ahead.
Thank you so much, Fotis. Before we wrap up, I'd like just a quick round of comments, because obviously change is not only driven by regulation, but this panel is very much about exploiting the power of investors. So in your role as an active investor, what are some of the key trends in investor engagement? And maybe that pertains to your own investors and you as an investor in companies. What are some of the highlights? Tony?
Okay, all right. We'll do the round again. I'm gonna use that question and also give my view on the last question that was asked. And One of the things that we're particularly keen on bringing to the attention of investors is actually a trend that is happening in the energy space that deals with wasted energy and losses. Losses are a big issue in an energy system. The grid systems are old, they're aged, and they need rehauling. The UK had, back in the 70s, about 80 power generation sites across the country. There are now north of 1 million. And what that tells you is that there's a democratization of the grids happening. There's more participants in the system. The grid system itself is changing, and it is promoting concepts like distributed generation. Distributed generation at its basis is a rooftop solar panel, and that is accessible for everybody to understand. You put a rooftop solar panel on your, on your roof. Solar panel is there. You generate power. You're somewhat self-sufficient. You draw power from it, and you're drawing less from the grid. You're less grid dependent. Co-locating power generation with a load center or a consumer is by far the biggest and fastest growing trend in energy on a global scale, bar none. This is the fastest moving market on earth, hands down. The issue with that market is we're talking about generation at a very small scale, but in aggregate in a very, very large context. And when you think about what that does with respect to efficiency and losses, you get away from the issue of reliance on the grid where loss factors are a reality, and you have to get away from it. In our engagement with investors, the one concept that hits home the most is actually the distributed generation concept. When we engage with investors and we explain to them that when we go to Brazil, 2-3 hours away from Rio, in a small town called Vassouras, and we're involved in investing in localized power generation to help local communities get a generator closer to a load center so that they can have more reliable power on a day-to-day basis, and at the same time help reduce energy bills for consumers of a corporate or blue chip nature that desperately need it also, who are building tower masts around the country, for example. We work with one of the country's biggest telecoms companies there. We have a 20-year arrangement for them to be able to benefit from that discount, and at the same time we're resolving this issue of getting away from losses. You explain that to investors, you get that into the minds of people, of understanding how you're providing energy access in a country that needs it, in a context that needs it, where a school on average had 3 to 4 hours of power a day. Can you imagine? 3 to 4 hours of power a day, and all of a sudden being able to access power for as long as the sun is shining. And the sun shines in Brazil. There's no problem with sunshine in Brazil. So, you need to be able to, bring those realities home, and that's what we spend our time doing at Victory Hill. We take those concepts, those ideas, and we bring them to investors and put them in that situation, explain to them how we invest and what difference they're making. And that drives a lot of reliance as well on us capturing data. We mentioned that earlier. The data point, I think, is extremely important, and being able to disclose that through TCF, DSFDR, and other regimes, brings it all home and brings it all together.
Thank you, Tony. Fotis?
Yeah, I'll respond to that question from the side of engagement we do with our investee companies. So, that's something we definitely focus a lot on. Once we invest in a company, to engage with them, sort of help them to understand what's best practice, and, be with them on their journey to improve their ESG and sustainability disclosures. So we do a lot of engagements on things like human capital and diversity, but more specifically on the green economy point, there's two things I would highlight. One is a lot of engagement with companies on carbon disclosures, and definitely encouraging them to embrace frameworks like the TCFD, have science-based targets. We think, no matter what you do, even if you're a services company with limited operating footprint and therefore emissions, you nevertheless do still need to disclose emissions and have a plan to reduce them. So that's one thing. And then the second, that was, a lot more in the recent years, we have been discussing that quite a bit more, is physical climate risk. So that touches on to the point that no matter what you do, you are exposed to physical climate risk. You could be a renewable energy company. If your projects are in areas that could suffer from wildfires or hurricanes, extreme weather events, you are at risk. So that is a piece of work that we have been doing in recent years, where we encourage companies to think about their geographical footprint and really go down at the very local city, village level, understand, are these areas water stressed? Are they in locations that we could have more extreme weather events? So this has sparked some interesting discussions that quite often we ended up discussing with boards of companies, and they took action on the back of that to mitigate these sorts of risks.
Thank you, Fotis. Minesh, the last few words.
Yeah, very briefly, I'll touch on the trend that we haven't seen and that I would like to see, which is fundamentally the investment proposition should be attractive. It's contributing to a net zero future, a better future, a greener future, a more sustainable future, whilst providing a financial return. There are not many ways you can have access to both. But the trend we are not seeing is mainstream take-up of the proposition. We have very loyal followers, very loyal shareholders, but increasing the awareness, and I touched on this earlier, outside of the investors who have historically been in this sector for the last 10, 15 years, that is the key challenge that faces us, whether it be retail or institutional. And I think, collectively as an industry, together with the LSE and other organizations, that is the challenge that faces us, and the theme we need to focus on is to raise awareness that this opportunity does exist out there.
Thank you, and thank you to the entire panel for your fantastic insights, and we look forward to working on all the work streams you've identified together. Thank you.
Thank you.
Yeah.